Risk versus reward. Is there an equation? Is it true that the amount of risk that you put in your investment directly pays off in reward? Do you know there are good risks and there are bad risks, and there are risks to do nothing at all? And today we will sort them out. So let's firstly define our terms. What is risk? Risk is the chance that something will go wrong. Pretty obvious, isn't it? Same thing in life. Risk. Oh, it's a bit risky. Do you know there are risks which are worth doing? I will give you an example. Let's say for a certain age group, say under the age of 55, 60, the highest chance of death to you, the biggest risk, is driving, jumping in your automobile. So you think, well, I don't want to take on that risk. I will never drive. I will never, ever get a license. I won't even catch the bus. Bus goes on roads. Roads are dangerous. All this is true. However, imagine the rewards which you're giving up on life. You would basically be stuck at home. You could only walk. Walking is safer. In most neighborhoods it is, but not everywhere. So you can see that most of life would pass you by if you did not take the basic risk of driving, or being driven at least. So where do you put your money as far as risk is concerned? Let's break that down. For some people, putting their money in the stock market they consider to be too risky. But then they're happy to put their money in the bank. But for other people, putting their money in the bank, well, we've seen what happens in certain countries, particularly where there's massive deflation, particularly where perhaps an authoritarian government takes over and you can't get your money out of the bank, for example. That is a risk. So what do you do with your money then? Put it in your mattress? Do you get there with a knife and hollow out the foam core of your mattress and stick your money in? Well, I'm sure some people do, but then maybe money is a risk. Maybe I can't trust government. I mean, it's not really gold backed anymore, is it? No, it is sort of fake money, money that we agree on to have value, and maybe I need to go into hard assets like pure gold, platinum, silver, things like that. That is the only thing which I can rely on. But then people are going to steal my gold, aren't they? They're bound to. So I've got to go and live in the woods and bury it all in a great big cave in order to keep it safe. And it's best that I not talk to anybody and I cut myself off from society because life is too risky. You can start to see accepting risk is in fact a part of life and is a part of the rewards that we get out of life. Let's back that off. So let's say you get out of your cave and you join society. Well, what can happen then? Well, you can enjoy the technology, the comforts, central heating, for example, air conditioning, food that you don't have to grow yourself, every little piece of it. Grow your yams, get onto it. Right, so joining part of society is a risk, but the rewards are so much better. In the same way, if you're in a stable country with a good financial system, the risk of leaving your money in the mattress could be worse than putting your money in the bank. You're certainly not going to get returns underneath your mattress. Now, if I put $50 in the mattress and come out, only two things will happen. Number one, I will get $50 out later, or number two, I might get nothing. Maybe the money's gone. Maybe my trusted neighbor next door, who knew I put my money in the mattress, decided to help himself. So most people would think that putting their money in a bank in a stable country is in fact perfectly acceptable, and why would you not? But of course you are taking a risk. Now let's talk about the reward. What is the reward? How much is your money going to go up by in percentage points? That's basically what we're talking about. Okay, so living in a cave does nothing for your money. Putting your money in a mattress does nothing for your money. And putting your money in the bank does. All right, so we're starting to get some risk where we're getting some reward. So this is a good thing. The question is the link between risk and reward real? Are these two things linked? If I go up the risk tree, will I in fact get more reward? That's what we're going to find out. Let's talk about the return by leaving your money in the bank. Well, it depends. There's two types of accounts in a bank in general. Number one is an everyday transaction account, where you'll get close to zero, basically nothing. Not much risk, no reward. The second type is what they'll call a savings account, or they might have special fancy names. Some of these accounts have special conditions, like you must put your wage into this account and you must not go below a certain balance or withdraw. There's all sorts of conditions, and those savings accounts have the highest amount of interest within the bank, but it's usually fairly pitiful. So, how much reward am I getting out of putting my money in the bank? Well, certainly more than putting in the mattress, but you're likely to keep basically pace with inflation or maybe slightly less. So inflation, of course, is where it eats away your money. We talked before about nominal rates of return versus real rates of return, which you can see in this video here, and I'll leave a link below. So let's go up the risk tree. Is it true that as I go up the risk tree into bonds, that I'm likely to get some more return? Well, kind of. There's basically 3 types of bonds, or 2. Depends on how you want to talk about it. Government bonds, municipal bonds, all those sorts of things that are basically based on taxpayers' return. The government can always raise taxes. They're pretty safe in most countries. So they're a type of bond. Corporate bond is the other type. Corporates, companies, big companies, small companies can all raise cash by lending from you and giving you a coupon or giving you interest on a regular basis. They're riskier than your government, typically, but they do provide more return. So as we're going up the risk category, the return gets better. Now, how risky are corporate bonds? Well, how long is a piece of string? Big, stable companies like Microsoft, Walmart, pretty safe in general, and I would have no problems buying bonds like that. Tiny little companies who don't have a proven income record, they're basically speculative companies, might be quite risky indeed, and we talk about them as being junk bonds versus investment grade bonds. But once again, as you go up into the riskier bonds, there is a higher rate of return. So it is true that junk bonds always have a higher rate of return, a higher interest rate that those bonds have to pay. It's the cost of them raising money in the market as opposed to big stable companies like Walmart, for example, in which case their interest rates on their bonds would be very cheap. Let's go up into the shares. Let's talk about S&P 500. Let's talk about large cap funds. How risky are they? Well, in most markets, they're in fact incredibly safe because you're buying into the market as a whole. And if your market has got a proven track record, like the S&P 500, ASX 200, and most developed capital markets across the world have got good track records. Not all of them. Japan had quite a flat period of time. So it might not be true that every single developed market is good for your money, but most of them are. And the risk versus reward suddenly shoots up. So on the S&P 500, you can get 9-10% return. Is risk versus reward when it comes to stocks a good idea? First of all, let's define the difference between the types of risk that we see in the stock market. Most people think, well, shares go up and then they drop by 40% and then they're up in double digits again and then they drop. The share market is super risky. It is untrustworthy because it's going to crash. The share market always crashes. I know, I hear it in the news. Well, number one, do not confuse perturbation, the amount of variability as the graph goes up and down, with the probability that you will lose your money in the long term. These two things are not connected. I'll say it again. The amount of variability in stock market prices as a whole in no way relates to risk. What does it relate to then? Why are my prices in the stock market going up and then dropping? Well, that's just greed and fear, which is behind those things, which means everybody in, risk on, everybody out, whoa, this is scary, risk off, and it causes massive changes in prices, but it doesn't really change the risk over the long term. So for those people who want to avoid shares because they are too risky, you've got to think, what is the probability of doing well in a broad-based index fund incredibly high versus the probability of doing really well on returns if your money is in the bank? Very low. That's not going to happen. So risk versus reward, as we can see, is in fact almost a direct correlation, except when it isn't. But wait a minute, haven't you just been telling me that as I go up the risk tree, I'm likely to get more rewards? Well, this is true, but do you know there are good risks and bad risks? Let's figure out what those are. Let's say that you're single and you would like a wife or a husband, or both perhaps. If you shelter yourself and never look, the chance of you actually getting married, getting a partner, is 0. It's probably not going to happen. Let's look at the risk of putting yourself out there and getting rejected. Well, if you look around in society, you will find out that the majority of people do, in fact, end up getting married. So, putting yourself out there and trying to date, you're likely to get married. So that is a risk which I can see is inherently worth doing and is a safe risk. What is an unsafe risk? What is a bad risk in an equivalent market? Well, let's say you want to get married, but you want to get married a different way. You see an ad in the paper which says, give me $10,000 and in fact, I'll arrange a wife for you. Totally trustworthy. Give them the money once. I don't even have to go on any dates. What could possibly go wrong other than you're being scammed? There are good ways of doing it and good risks, and there are bad risks. If I put my money in the bank, what is the probability that I will go bust, that I won't get my money out? In a regular stable country, it's small. If I go into corporate bonds, into investment grade bonds, is my risk greater than 50% that I'll in fact get my money back and get the interest rate? Well, in fact, you most likely will. There's probably a 98% chance that things will go well for you. So well worth doing. What about shares? Really, over the long term, the share market, a broad index fund, is virtually as safe as putting your money in the bank. Not quite, but the rewards are tremendously more. I know I'm going to take all of my money and find a brand new startup. Maybe it's a startup that embeds chips into your arm and it's going to be wonderful. It's going to replace cash. There'll be no need for cash because, you've got your chip in your arm and nobody can rob you. You don't have to carry it on your wallet. You don't have to carry your ID. It's going to be wonderful. Just, beep, beep. Chip in. Yes, I can hardly wait. I'm going to take all my money and put it on this one stock because I know it's going to be amazing. It will be the best next thing. No, it's not going to be. Think about your probabilities. Now, the reward could be, in fact, amazing if it works out. If it works out. What is the probability of this type of venture working out? Is it greater than 50%? No, it's not. It's not. Unproven companies with no track record at all, with a brand new, crazy out there idea, the probabilities of them becoming a massive company is in fact not particularly high and probably not greater than 50%. So we come into the idea of diversification and why that might be necessary to mitigate risks. Diversification we will cover in another video. As I would not put all my money in this chip company, this startup, in fact I might not put any in it, I would not put all my money in any particular company, even if it's a wonderful company, even if it's, say, Walmart. I think, yes, it's going to be around forever. I mean, people sleep in its car parks. What could possibly go wrong with this company? So risk and reward, very much correlated. It is true, we've found that out. But avoid those who are genuinely risky risks. Safe risks, perfectly acceptable. Opportunity risks, you don't want to regret your life on your deathbed when you think, well, my cave was comfortable, I took no risks, but guess what, I got very little in return for it. What I want you to do is subscribe and then watch this video right here. It is going to have some really useful tips for you.